Wasted money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
So welcome to the first of our evening live streams this exam season. Had to change the time to 7 o'clock tonight. I hope you can make half an hour with us. If you're watching us live, subscribe to the channel so you can contribute to chat. John's circadian rhythm has been disrupted and messed up big time, bigly, as Trump would say. And we also have the Snap Bandit joining us live from Singapore. I think it's about 1:55, just before 2 o'clock in the morning. Now, either he stayed up very late for this live stream or he's got up very early. Must be one of those two. So today we're going to look at exchange rates. We think this is a big one because exchange rates not really been tested in a meaningful way significantly in recent times, and maybe with a development focus as well. Again, development barely scratched the surface, certainly with that Excel paper too. So we'd expect a lot of development economics. Now tomorrow we're going to do an AQA live stream, all being well, 11:30, and then Wednesday our final live stream is going to be Edexcel revision clinic. So we'll focus on the specifics of the exam technique for both papers. Welcome everybody if you're joining us, and we know lots of people had exams today, geography, CP2, psychology, so you're probably feeling a little tired. Let's crack on with half an hour on exchange rates. Here's the first one. I've got 5 multiple choice questions for you. An economy has a deficit on the current account of its balance of payments. Which one of the following sets of circumstances is most likely to cause the deficit to get bigger, to increase? So a country has a deficit on the current account. What's going to cause the deficit to go up? And answers are coming through. Lucian says it's B, brackets, I don't do economics. Lucian, you're really close actually. It's not B, but you're really close. Most people are saying C. Let's double check. It is indeed C. I had a student last year who said, Okay, I don't mind getting questions wrong, but if I'm really close, like if it's C and I put D, should I only get half a mark? Because there's only one out. Strange logic, seemed to work. Snapband, it says C, but can be Marshall learning condition dependent. Very rare that we, in a live stream, we get people trying to evaluate multiple choice questions. Question number 2. When using data to make cross-country comparisons of living standards, purchasing power parity exchange rates are more useful than market exchange rates. Correct. This is because PPP exchange rates consider differences in what across and between countries. Lucian's changed his mind. He thinks it's now C. It's okay to change your mind, by the way, Lucian. It's okay to change your mind. So most people here are going for D. Let's double check. It is price levels. They try and make taking a representative basket of goods and services, try and compare relative prices between countries. And I'm very pleased to say that there's a flood of answers saying D, which is good news. Because it is D. Question number 3. An economy is experiencing short-run growth accompanied by falling unemployment. And this is due to rising AD following the introduction of expansionary fiscal policy. Which one of the following is most likely to help the economy avoid rising inflation? What do we think here? So you've got fast growth, unemployment falling. What's going to help bring down the inflation rate? Quite a bit of a difference of opinion here. You already have short-run growth fueled by falling unemployment. So you don't want to increase aggregate demand still further, which is why it won't be B. So a lot of people here saying B. It's a quite interesting distractor, that question. That option. Charlie and Alex, David and Esther and Amy have all gone for D. Let's double check. It is. Rising exchange rate dampens aggregate demand, makes exports dearer, imports cheaper, and rising productivity shifts short-run aggregate supply out, increasing supply potential and reducing unit costs. Question number 4. Now, in the exam itself, just to give you a little warning on question 4, in the exam, the actual paper itself, only 1/3 of students got this question right. The table below shows the average exchange rates and currency valuation estimates for 4 countries against the US dollar at the start of 2016. Which one of the following can be concluded from the data? Now, keep in mind, only 1/3 of students got this right. It's all about valuation of exchange rates, undervalued, overvalued. And George is right, this was an AQA question. Quite a few people joining in late. Don't worry, people revising for Maths Pure tomorrow. We appreciate you being with us. Most people here going for A. Let's double check. It is indeed A. Yeah, the krona was closest to its PPP exchange rate. Now, I think that's a sign of the quality of this group, I think, isn't it? We're voting tonight for our live stream of the year, and it's been super tough to nominate 4 people. We could have added a naught on and no diminution in justification. So the fact that most of you getting the right answer is super encouraging for me anyway. Question number 5. All other things being equal, ceteris paribus, under which of the following circumstances is an economy most likely to experience deflation? Deflation. You have 3 variables there: the exchange rate, labour productivity, and employment. Under which of the following circumstances is an economy most likely to experience deflation? And so quite a few differences of opinion here. So you're looking for the combination where all 3 would probably be deflationary. In quite a few of these, there are 2 that are correct, but the 3rd one isn't. Just need to take a moment on this one. Good range of answers coming through. I guess most people going for D, a few people going for B. Let's double check. The answer is indeed D. Higher exchange rate dampens import prices. Higher productivity reduces unit costs, and falling employment reduces demand. All 3 are likely deflationary. Superb. Right, let's crack on. Conscious of time here tonight because we've got CP2, I think, or Maths tomorrow. Pure Maths tomorrow, isn't it? I want to give you 3 contexts. It's just me having a punt here, really. So exchange rates, remittances. Huge remittance flows in the world economy, as you know. Last year, $669 billion to lower middle income countries. USA, Mexico, India, China, Philippines, Egypt. I mean, tens of billions of dollars flowing in terms of remittances. Here's my question. Explain how a rise in net inflows of remittances might impact the external value of a country's currency. Have a go. So for many countries, remittances coming in are a substantial percentage of country's GDP. And crucially, explain how a rise in net inflows. And this could well be an exam question. It wouldn't necessarily be a 25 marker, but it could be an explain question. So Evan's gone for a currency appreciation. John agrees. And for some countries, this is a significant factor, actually. Yeah, Hayden. So most of you, not all, most of you going for an appreciation. Esther says increased demand for domestic currencies and remittances paid in domestic currency leads to a currency appreciation. Not bad, not a bad answer. Yeah, so G9 linking remittances, it's a net inflow. So very not dissimilar to FDI or hot money. Demand for money, demand for that country's currency shifts to the right. Exactly right. Let's just double check my explanation. And too often, well, not too often, often in these live streams, this is number 37, I think on number 38, the answers in the chat window are better than mine. It's not hard really, but here we go. Remittances are typically sent in foreign currencies. So, you know, you've got somebody living in Mexico who sends some money, living in the States, sends some money back to Mexico. You've got to convert into the local currency by the recipients for their use. So that increases demand for local currency. Other things being the same, remittances can cause a significant currency appreciation because it's a net inflow into the economy. Now, keep in mind that could well be a kind of exam focus. Remittances link to the exchange rate. Of course, that then has consequences, micro, macro. Good stuff. Yeah, now let's look at this next question. Japanese authorities have stepped into the currency markets on Monday. That was actually last Monday. After the yen hit a 34-year low of 160 yen against the US dollar, partly because the US Fed Reserve probably has to keep interest rates higher for longer. The Japanese central bank does not want the yen to depreciate further. So move away from Abenomics in that sense. Here is my question. Can you please explain how the Japanese authorities might intervene in currency markets to prevent a depreciation of the yen? Have a go. This is quite an important question. It's on the spec, by the way, for every exam board. How does a central bank intervene? Now, I want you to make a distinction, if you can, between direct intervention, which is Liam's point, and indirect intervention. You need to know both, and I'll walk you through both examples. Okay. David linking their QT a little bit. Quantitative tightening, good. So we're looking for direct intervention and indirect intervention. Loads of great answers coming through in the chat window. Yep. Max has it. In fact, Max has absolutely smashed it. Well done, Max. Good stuff, everybody. You're doing well. We've got good numbers in tonight, although we know we've got big maths paper tomorrow. Grace says sell foreign currency reserves in order to buy up the yen in the market. That decreases the supply of the yen and leads to appreciation of the yen. Nicely explained there from Grace, and others have been chipping in with something very similar. Here's my answer coming up. Yes, so direct intervention, the Bank of Japan goes into the market, BOJ goes into the market, it buys yen using dollars, Chinese yuan, using whatever it is, sterling, euros. So they basically buy yen. This increases the demand for yen, which other things being the same can support the value. Indirectly, of course, they can raise interest rates to attract hot money into yen-denominated assets, property, bank accounts, etc. As you know, the Bank of Japan has just moved away from a negative interest rate policy. So they're worried that the yen is too weak, and they want to just manage the exchange rate a little bit. Of course, the evaluation is whether this actually works. Bank of Japan is a big central bank, and they throw tens of billions of dollars and things at these issues. Noah says, Jeff, could buying yen reduce supply available for others? That's exactly right. It basically reduces the amount of yen that traders can buy. All good stuff. Okay, superb. Let's move on to Bangladesh. Now, the reason for showing this, I've actually showed this chart a couple of times in the live streams. Go back to the summer of 2022. Now, if this comes up, obviously I'll take the plaudits, but back in 2022, when the exams were set, Bangladesh moved away from a fixed exchange rate to a managed floating exchange rate. So the taka, as you can see, was pretty stable through the pandemic, semi-fixed system. Now they moved to a floating system, and the taka has depreciated. So they have to give up many more, 107.20 to buy $1. And it's actually fallen by 26%. Okay, so the Bangladesh economy has moved to a floating exchange rate. Here's my question, at first thinking synoptically. Before we do that, by the way, of course, here's the great chart, great export pattern chart showing Bangladesh's heavy dependence on manufacturing and then exporting textiles, from knitted sweaters to woolly hats. But of course, they import raw cotton, they import wheat, they import refined petroleum and scrap iron and palm oil. So those are the things on the right-hand side that they import. Keep that in mind. Here we go. Here's the first synoptic question. Can you give me two microeconomic effects in Bangladesh of a currency depreciation? Have a go. We don't need too many real-world examples for Edexcel. Of course, I think the whole point about Edexcel Paper 3 is that the vast majority of the examples you have will be from the extracts. But the 25 marker may well say using an industry or a country of your choice. And I know as an examiner, I know that I always reward students who are good economists, who show a good awareness of what's happening in the world. Guy has a nice point about imports. Sadiq talks about variable costs. What I love about the answer from Sadiq is that it's a micro point. Increase margin, average cost, reduce profits. That is a really good micro point. The only way I would improve that, Sadiq, would be to give me an example of an industry in Bangladesh affected by that. Patrick does something very similar. Harriet likewise. Oh yeah, harder, more expensive to import capital machinery. Now what you're all doing there is really good analysis. All I would say to the group, and there are some good answers in the chat by the way, look for application. So think about the chart I just showed you. What does Bangladesh import? So there's a great answer. The cost of importing cotton for production of textiles increases. So that is really, really good application. So cotton may be passed on consumers' higher prices, etc. Okay, this is the, if you're an Edexcel Paper 3 fan, this is what we're looking for. Good micro analysis, but good micro application. Okay, here's my answers coming up on the screen for you. I've gone for falling real incomes of individual households at risk of poverty. So depreciation causes a rise in the price of imported food and energy. So the refined petroleum becomes more expensive, and higher inflation tends to have a regressive effect on poorest families. Possible rise in revenues for Bangladeshi firms. Okay, so a weaker exchange rate, in theory, makes it more profitable for exporting, outward shift in AR and MR. But of course, some of you already evaluated that by saying, well, the cost of imports will go up. So that's perfectly good in terms of analysis and evaluation. Let's crack on, everybody. Hayden says, realistically, who is a Paper 3 fan? Well, I am a big fan. Okay. By the way, I'm also a big fan of those huge wind turbines. Well, I'll give you two macro benefits for Bangladesh of a currency depreciation. Have a go. I think we should all be fans of Paper 3, especially at the end. She looking a great answer there. Oh, linking it to cyclical unemployment, derived demand for labour, demand pull inflation, current account. Wow. Incredible. Incredible answer. Well done. The breaking news, by the way, those of you joining, is that Faye has just overtaken Liam and G9 for a podium place in our live stream of the year. So please do vote if you haven't already voted. Yeah, some good stuff. Oh yeah, our current account is macro. Yeah, structural unemployment. Yeah, so Mariam, exports more competitive, good. Shifting at 80, and then link it to growth, link it to GDP growth, the upper gap. Now, most people actually, the exams report is quite interesting. We'll talk about that on Wednesday. Most students find it easier to talk about macro effects than micro. Okay, so that banded. Textiles are a highly competitive market, perhaps unable to pass on costs, may not offset the increase in factor import costs. Correct. Most exports require imports. Here are my two answers. Great answers coming in from everybody. I've gone for net trade. Depreciation causes expenditure switching effects. In theory, it should improve Bangladesh's trade balance, but it does require the marshal owner condition to be satisfied. And then I've gone for kind of growth story. As exports rise, possible multiplier effects, possible positive accelerator effect. The weaker currency might also attract inward FDI, people thinking, well, we'll use Bangladesh as our base for manufacturing to other parts of Southeast Asia or even to the European Union. I don't think the currency itself is particularly important in that decision, but it's certainly a valid answer. Isabella says, when is the choo-choo end of exams party? Great question, Isabella. I'm assuming you didn't get the invite because they were all sent out just a few days ago. Our big party actually is August. We're going to celebrate all of your successes, all of your hard work in August. And believe me, it will happen. Okay. You might have the odd dodgy paper, the odd up and down day, but believe me, the work you're putting in will have its reward. You just have to believe us. Next question, macro costs for Bangladesh of a currency depreciation. Have a go. Conscious of time today, everybody, so we're going to try and keep this fairly short. In fact, I've just got one more country to look at. So we have looked at Japan. We have looked at remittances. We've looked at Bangladesh. We have one more country to look at in our final topic video. So what are the risks for Bangladesh of that significant 25% depreciation or something quite significant depreciation? Whilst you're writing the answers down, have a think about the diagram you would use here. Queen Bee has a great point about external debt. If this kind of topic comes up, Queen Bee, I think that kind of external debt issue is super important because that has consequences too. Yeah, Evan comes in with a J curve. Joy has a great answer. Can we pick out Joy's answer? Absolutely superb. Here it is. Can lead to capital flight and outflows of money from the financial system. Yeah, so the Bangladeshi banking system may be less liquid. Increases yields on government bonds. It's more expensive to borrow. Those are fantastic points about a currency depreciation. I think it's in the context of Bangladesh in particular, where it has big infrastructure needs and fairly high savings, but low per capita income. So you need to be able to finance your capital investment. Sachs talks about the real value of debt. In exchange rate terms, it goes up. Yeah, so it becomes harder to service the debt. What have I gone for? I've gone for higher inflation. A little reminder that these points are all valid. Many exports require imports. So Bangladesh export textiles, but import petroleum, cotton yarn, wheat, and pharmaceuticals. So there could be a compensating, offsetting effect. And of course, that's even worse if the inflation expectations become embedded. And I think some of you mentioned this, the cost of servicing external debt. So if you've borrowed money in US dollars or euros or Chinese yuan, you have to spend more paying the debt back. And of course, that can cause a foreign exchange reserves and the risk of capital flight. John says, what's for dinner today, Jeff? I just think, John, Harrogate, what do you know Harrogate for? Harrogate's all about fish and chips on a Monday night. Okay, let's crack on. Just one more thing to look at. Let's go to China. Now, I've got an interesting calculation question for you here. In May 2022, $1 bought 6.37 Chinese yuan. 2 years later, $1 bought 7.24 Chinese yuan. Here's my calculation question. Can you calculate the percentage change, please, in the external value of the Chinese yuan over those two periods? Have a go. The Marshall Lerner condition can apply to a currency appreciation. You get a kind of inverted J-curve effect. So you can apply it. It's not part of the spec, but you could use it. Answers coming through. It's the percentage change in the external value of the Chinese currency. And there's quite a few of us here where we just have to tweak it slightly. $1 bought 6.37 yuan. 2 years later, $1 bought more yuan. So what's happened to the Chinese yuan? Good to see people putting their 1 DP or 2 DP into the answer and make it nice and clear. Yeah, the percentage change coming up on the screen, just a slight tweak. It's actually minus 13.7. It's minus 13. There's a fall in the yuan because you now have to buy, you give up more yuan to buy $1. So the value of the yuan has gone down. The external value has fallen. I always says, don't we always need 2 DP? No, you don't necessarily. As long as you tell the examiner that you're calculating to 1 DP. So it's minus 13.7. There's a currency depreciation, okay, in the Chinese currency. So 13.66. If it was a 2 marker AQA or something, or part of a 5 marker on Edexcel, you would probably need the minus sign. Ed says how many DP needed for Edexcel? The default will be 1, unless you ask for more. Okay, don't worry too much about it, but just read the question carefully. Okay, our last questions tonight. Conscious of time, everybody, because people are busy tonight. Huge question. Fixed versus floating exchange rates. The standard policy recommendation for China over the last 15 years is that it needs to allow its exchange rate to be set by the markets. USA, Euro, Japan and UK have independent central banks that basically rarely intervene in the foreign currency market. Certainly in the UK, China's been reluctant to do this because of their export-driven economy, which favours a weaker exchange rate to preserve competitiveness in several key industries, such as EVs and household appliances. A lovely article, by the way, I found from the Council for Foreign Relations from Brad Setzer. Too late, that's too recent for the exam, but the story is still relevant. Should China move to floating exchange rates? Well, here are 2 questions to finish with. Can you give me 2 arguments in favour of China nudging towards a floating currency system? Penultimate question in our 40-odd live streams. Here we go. Yeah, 38, 39 live streams. Goodness knows how many questions we've asked. The quality has been insane. So here's our penultimate question. So Liam talks about probably a reduced risk of speculative attack. I think that's true, actually. That in a fixed exchange rate system, dealers tend to attack the weakest currency in the fixed rate system. Ed says that China can use monetary policy for other purposes, which is a good point. Bank of Japan can, Bank of China, People's Bank of China. Some good stuff. Because, okay, yeah. Yes. That's an argument in favour. So presumably if they move to floating, the yuan would go up. Chinese companies could import capital more cheaply. Esther links floating exchange rates towards partial auto-correction of a trade deficit. Not the case with China, with the trade surplus, but a pretty valid point for most other countries. Yeah, most of you talking about automatic adjustment. Grace says there is a rising middle class in China. Will China grow old before it grows rich? Floating currency may lead to appreciation and a falling cost of imports, allowing an increase in the choice of goods for consumers, increased living standards. Particularly if the Chinese government is willing and able to allow those imports to come into the country. So great point from Grace. The Snap Bandit comes in with a typically erudite piece of evaluation. Floating exchange rate can actually be more stable than the poorly attempted fixed exchange rate, particularly when the speculators target central bank credibility etc. I think there's a valid point. Don't assume that floating exchange rates are volatile and fixed exchange rates are stable. They're not. They don't always have to be. It's slightly paradoxical, but it's true. Great stuff. I've gone for the following. I've gone for shock absorber. I think this is a super important point, actually. A floating exchange rate can be a kind of buffer. It's like a macroeconomic buffer stock. So if there's a big fall in demand for Chinese goods, world recession, all things being the same, the yuan would depreciate if it's floating, making Chinese goods cheaper. And also, because China's been accused of deliberately manipulating the exchange rate in a semi-fixed system, a move towards managed exchange rate, market-led exchange rates, could in theory reduce some of the trade tensions between China and the States. And if their current account surplus just go up, then the exchange rate appreciates and helps to basically maintain a balanced current account. So you really can't divorce from this question the geopolitics of exchange rates. Exchange rates can act counter-cyclical to the business cycle. If you want a bit of evidence for this, the Bank of England reckons that every 5% fall in the exchange rate is equivalent to a 1% cut in interest rates. And it works both ways. Last question, our final question in our topic videos this year. So please do have a go. Can you give me 2 arguments in favour of China sticking with a semi-fixed exchange rate? Have a go. John says, Jeff, all this talk has inspired me to order a Chinese takeaway tonight, potentially increase remittances out of the UK to China. And I think sterling has already moved since John posted that in the live chat. If you haven't already voted, by the way, please do vote in our economics live stream of the year. We're going to close the vote in about 30 seconds. We do have a winner, but who's going to come second? Great answer there from Max about the Dutch disease. Yeah, that gives China more control, doesn't it, over the structure of the economy, the economic structure. And Joy links it again, reduce risk, currency volatility, potentially being a positive factor for foreign investment. Liam talks about a semi-fixed exchange rate that allows a more stable currency. In theory, Liam, correct. China also has a huge amount of foreign exchange reserves due to its current account surplus. Therefore, it's easier to manipulate the value of the yuan to keep it stable. A great point there. The accumulated impact of current account surpluses gives China the wherewithal to do it. G9, more stability, greater certainty for firms who import-export. And again, FDI is probably more the risk premium goes down because you're not prone to lose money from external speculative attacks. Utterly brilliant. Now, we've just got a few more seconds before the vote closes. So if you haven't already voted, please do vote. I've gone for certainty. Reduce risk, investor risk, FDI risk. And also China is actually at risk of deflation at the moment, a bit of knowledge there. Therefore, it wants to avoid a large currency appreciation. I think a 10-15% appreciation of the Chinese currency would probably tilt China into deflation. And China wants to avoid that. And secondly, competitiveness. By maintaining a semi-fixed exchange rate, China can keep its exports competitively priced. And again, if you allow the yuan to float, other things being the same, the yuan would rise in value. The markets would drive it up, and that would price some Chinese companies out of world markets, even independently of things like tariffs and quotas. Wow, great stuff. Now, people are getting slightly worried that the Snap Bandit is either staying up too late or getting up too early. Either way, it's not good to do that. Although some of you got maths tomorrow, so presumably burning the midnight oil. Although we've had an amazing, 3 months together, haven't we? I mean, Epic Econ 7000. This Snap Bandit performance is like Vinny scoring in the UCL, just cementing his Ballon d'Or. Indeed, can't add to that. Snap Bandit is generational, a student for our times, I think. 55% of the vote. Liam came second with 16%, Faye with 15%, G9 14%. And all three in the second, the third and fourth are worthy of our congratulations and our celebrations. But I want to say thank you to everybody who's contributed over the last 40 odd live streams. It is a real privilege for me to be your tutor on these sessions. The format is pretty similar, isn't it, most times, but hopefully you felt that they're useful. You got some good economics out of it. We hope to stay in touch with you. Please do let us know after the exams, how they've gone, but also crucially, when you have a big summer break and have a wonderful time. When it comes to August, if you have good news, please let us know. It's one of the great days for us to find a message from a student who's been on the live streams, who felt that we've made maybe a small, modest difference to the outcome. It makes it all worthwhile. Most of all, keep going, everybody. We have an amazing group. You will be fine. Whatever happens in the papers Friday or maths paper tomorrow, you'll be fine, because exams aren't really not the end of your academic journey. They're just a staging post. And you all work so hard on your economics, you really do, that your answers will shine through. And if I read a phrase saying that macro has micro foundations, or that many exports require imports, then I'll know you've been on the live streams. Evan says, Jeff, could you just tell us where you went to Uni 1 last time? That sounds like Ariana Grande, doesn't it? One last time. Evan, I went to Cambridge and I read economics at Cambridge. And that was in the early 1980s. Well, August stuff, it's time for me to say goodbye, because you've got maths tomorrow, many of you. And if you haven't, you need to crack on with the revision. Do get plenty of fresh air. As always, stay happy, stay healthy, stay positive, stay curious, and let's all see each other sometime soon.